Tariffs are essentially taxes imposed on imported goods. They're used to protect domestic industries, retaliate against foreign policies, or send a political message. But when tariffs go up, the cost of goods often follows, and that cost, usually, hits businesses and consumers. This introduces what economists call cost-push inflation, where rising input costs are passed along the supply chain. Over time, this distorts prices, squeezes margins, and impacts demand. This type of pressure might impact small companies more than larger ones, because small companies do not have the same leverage to negotiate input prices. Tariffs are being used by many countries. Looking back at the last few decades, it does appear that tariffs being imposed on the U.S. are generally higher for foreign countries than what the U.S. imposed on those same countries. In part, this has led to trade deficits as the U.S. imported more than what it exported. However, even in cases where tariffs are zero, you can still have trade deficits simply because of the lower cost of labor overseas or because a country offers certain products that U.S. consumers want. Trade deficits for the U.S. also reflects differences in natural resources, comparative advantage, and development levels. The economic chain reaction. When tariffs are short-lived, companies can absorb the hit, but when they stay, businesses start to shift supply chains, a costly and slow process. Tariffs generally reduce efficiency. That leads to stickier inflation, even in the face of weaker demand. And that forces central banks, like the Fed, to hold interest rates higher for longer. It's not just about trade, it's about how global cost structures evolve and where the pressure lands, whether on margins, jobs, or monetary policy. So, what does this mean for markets? In equities, rising input costs can hit earnings, especially in sectors like consumer goods, autos, and tech. Supply chain disruptions create uncertainty, and markets hate uncertainty. The VIX index is one indicator that can help illustrate the level of uncertainty. For bonds, it's all about inflation expectations. Higher inflation means lower bond prices and upward pressure on yields, particularly at the long end of the yield curve. And if the Fed delays cuts to fight off inflation, that strengthens the dollar, weakens emerging markets, and tightens financial conditions even further. Interestingly, as we saw the recent equity sell-off, bond yields have gone higher. Typically, you would see government bond yields drop in a flight to quality. In this case, maybe investors think that the government will have a harder time managing debt levels if a recession happens. Tariffs don't just affect domestic markets, they ripple across the globe. Export-heavy economies like China, Germany, and Southeast Asia take the hit as demand slows. Capital flows shift away from emerging markets. Currency volatility rises. And in some cases, we even see currency wars, where countries devalue to stay competitive. Global trade becomes less efficient, and growth becomes harder to come by. Some could argue that foreign countries have already imposed tariffs, currency manipulation, and non-monetary tariffs on the U.S. These can be all viewed as leading to trade imbalances. Long-term outlook and positioning. If tariffs become a permanent feature of the new economic landscape, investors may need to adapt. That could mean tilting portfolios toward defensive sectors, looking at hard assets like commodities and gold, favoring companies with domestic supply chains or those with pricing power. Note that panicking and following the herd can be very costly in the equity markets. That said, depending on the individual's time horizon and need for funds, repositioning might be the prudent path. Someone who has a long time horizon and can weather the volatility may have a higher risk tolerance than someone who is reaching retirement age or is already in retirement. For fixed income, it could mean favoring short-duration bonds or even inflation-protected securities, depending on how rates evolve. The key isn't prediction, it's positioning. Understanding the macro forces and adapting accordingly. Tariffs may seem like just another policy tool, but they affect everything from what we pay for goods to how markets function. As the world deglobalizes and inflation remains sticky, understanding the bigger picture becomes more important than ever. If you found this helpful, subscribe for more macro breakdowns, market analysis, and frameworks to help you stay ahead of the curve.